We're not going to go to break. We're going to go to Lyle right now. Your take on the Canadian economy after we got those higher than expected inflation numbers yesterday.
Yeah, our concern about the Canadian economy is that it's not the growth engine that it used to be. A couple factors are coming through quite loudly. Inflation pressures yesterday. You know, the expectation that the Bank of Canada will be quicker to decline interest rates here, we're kind of dampened by that, and that's a problem. Why is that a problem? Why is inflation a problem in Canada? Again, we talked about it earlier, wage settlements are much higher. We've got a debt problem, and that debt problem isn't going to go away with that level of inflation. People are concerned about how they buy the groceries and how they pay for their rent, and that's not going away. At the same time, because of this debt problem, you're seeing additional pressures. Look at the real estate market, for example. Mortgage costs were the biggest component with respect to that inflation rise, number one. Number two, you're seeing governments in Canada, municipal governments, looking for new tax dollars. You know, we're talking about a 10% rise in the taxes in Toronto, if not higher. We've seen 20% increases in Vancouver over the last couple of years. The cost of living in Canada is going up. People aren't happy, and governments can't pay for it all. You know, there's a growing reality that we just have too much debt. So that's a damper on the Canadian economy, and I think it's something that's going to play out over the course of the next while with respect to the dollar, because if the Bank of Canada does cut, then the dollar comes under pressure. That's more inflationary. They're in a bit of a pickle. So when you put that all together, it's not the big growth engine that it was.
And one of the portfolio moves or orientations that you've adopted as a result is avoiding the Canadian banks. Is that correct?
Correct. We have been highly underweight Canadian banks for two reasons. Number one, the macro factors that we're talking about, but their just ability to grow is difficult in this country. And they are also subject to, I would say, abnormal taxation. You look at the $1 billion that they have to pay to the government because of their fare, or whatever the government called it back during the COVID days. This is an undue burden that is made in Canada. And that's an issue that investors don't need to participate in. We can go elsewhere. We can go to the U.S. We can go to Europe. We only own one U.S. bank, a regional, but we'll talk about that. I mean, the point is there are opportunities to get your money out of Canada, and that's one of the themes, is being a global investment shop as well. We see lots of opportunities on a lot of different places.
And very quickly, you've increased exposure to Japan, which has been a story of great gains over the past year.
It has been good. I'd love to say we bought when Warren Buffett was buying, but we didn't. But the fact is we are there, and we see that as a great place to own manufacturing companies, a great place to own basically companies that can grow their earnings and you don't have to pay a lot for PE multiple. Plus, there's now a culture, I would say, of corporatism that is working in Japan. All that works in its favor, and as money comes out of China, it's got to go someplace, and money flows will be good as well.